And there you have it. The markets are officially closed on this Wednesday, September 10th. Welcome, everyone. Thank you for that little, forgive me for that little mishap, but we got a lot going on here. And we have so much news to put out in this 30 minutes. I don't even know what to start, but I will say this. If you could all please pray for Charlie Kirk. It was about an hour ago. He was shot at a rally. I believe it was in Utah, and our hearts go out to him, his wife, his two kids, and very, very unfortunate turn. Coming at a man that never spoke a word of violence. Never once did he call for violence ever. And it's pretty incredible how people could lash out and having open conversations with folks. I mean, it doesn't matter if you like the person, dislike the person, hate the person. Violence is definitely not the answer. Now, aside from that news, that very sad news, what do we have going on in the markets here? Because I know we have quite a bit of content with individual stocks, especially the ones that we've been trading. But I'll let you kick it off from your NODLive news feed, and then we'll pick up the charts. And by the way, hopefully all of you members, especially who are watching live, feel free to put comments and ticker symbols into the chat, and we'll do our best to try to squeeze that in whatever time we have left in this 30-minute segment. So go ahead, Nod, take it away.
Thanks, AJ. And again, thank you everyone for joining us live and on replay. We do appreciate your time. And ironically, AJ, my theme to kick us off was what is going on? So this just adds to it. But back to much less important data, because it's life is much more important. But the PPI we got this morning did come in lower than expected, which ironically is raising the call and ask for larger rate cuts, which may be coming at the end of the month. And as we know, that's going to impact inflation, which we'll get to later, AJ. NVIDIA's market cap, just to give you some perspective, is now larger than every country's listed stock exchange other than the U.S., China, Japan, and India. And that's per Deutsche Bank. And speaking of Deutsche Bank, they did a two-way today. They raised the S&P target to 7,000, but then they said that they are worried about a bubble risk in the S&P. So I guess either way, they can't be wrong. So we'll call that hedging in our mind. But AJ, you and I spend a lot of time on gold and silver, and they may not be the prettiest or sexiest of names, but what I want to do really quickly is pull up this first chart here, because what this does is this shows the Vanguard Total Return Fund, which is just kind of an aggregate exposure to kind of all the things in the equity markets, versus the Gold Trust ETF, the IAU. And if you look at it, the returns in both over 20 years are exactly the same. So AJ, before I ask you to do a deep dive in gold, I do want to pull up this one more cool chart in silver, because if you look at this, AJ, what I see is a 45-year cup and handle breakout. So if you wouldn't mind just doing us all a real big deep dive on both gold and silver, and let us know what you might be doing personally in each, I'd appreciate it.
Well, I'll start off with the silver, because today we put out a publication on AG, which I have the chart up here right now. Before I get into the analysis of AG, I want everyone to know that I took a fairly large position in AG today, and it's rare that I announce that to the public after I've taken the position. Usually I let the public know that I'm about to take a position, but the way the candles were today, there was a beautiful bullish harami, as you could see here, that follows a bearish engulfing yesterday. Now, let me just take this one step at a time. For those who are brand new to candle charts, a bearish engulfing is when you have a big, long red candle that engulfs, or you could even say eclipses, the previous green candle. That's taken as a fairly bearish signal, especially when you're at the top of an upward leg, like we see here. However, when you see a bullish harami show up after a bearish engulfing, that more or less negates the previous bearish engulfing, because what that's telling us is that the buyers are saying, nah, sellers, we're not going to be selling. We're going to be buying right now. Maybe you sold a little bit too early. So they kind of stick it to the sellers that came in yesterday, and it's up pretty nicely. Back here, you could see a bullish harami and how that worked out. You see, here's a bearish engulfing. It opened up a little bit lower the next day and then traded up. But this is a bullish harami. Now, before I get into gold, I just want to show you the monthly chart on AG, because this is pretty amazing. It's not necessarily a cup and handle, but what I see here are some rounding bottoms. These are also known as saucer bottoms. So here we are at what I believe is the beginning stages of a saucer that could complete up here around $22 to $25 as you reach these, historic highs back here. So for the folks that have read some of my zero hedge articles on gold and silver, I put a silver target at $50 an ounce by the end of this year. I'm stretching that. I'm really sticking my neck out on that one. That would be a good hard rally to get to 50 by the end of this year. But all my gold targets that I wrote about in zero hedge have hit. And if you look at GC, which is the futures, this was the cup and handle that I wrote about in zero hedge before we even hit that target. My original target when drawing a cup and handle is you take the depth of the cup and you attach that to the breakout point, breakout point on the cup and handle. So my gold target was 3,000. Obviously, it's blown over that by $681. Now, can this keep going higher? That's a big question. Now, looking at the technicals, everything about this chart in gold and even in silver is looking technically way, way overbought. However, there's a good number of factors that are affecting the precious metals markets. Number one, if you look at the delivery notices on silver, here's the futures for silver. Look at that. It's approaching the all-time high of $50. I even have my little mark there for the target. That's my target right there for silver. We're approaching those. But if you look back in 2009, after the crash of 2008, what happened, silver went on a rampage, just kept going vertical, even while the technicals were showing us overbought conditions the whole time as it was going to those high levels. So can it keep going? Yeah. But the other factor that you have to consider, especially with silver, is that the commodity exchange, COMEX, which I was a member of for 10 years, I was also the chairman of the option floor trading committee for a few years there as well. COMEX is getting really pressed on their delivery notices. In other words, people who buy the futures contracts are actually taking delivery. They're not rolling into the next expiration month. And then for the icing on the cake, for those who are silver stackers, I got to tell you that the Department of Interior has published their draft list for the critical minerals list for the U.S. That is expected to be finalized and published by the end of this month or at the very beginning of October. Now, if that happens, it's now mandated for the U.S. to buy silver and copper, which is also on that list. So I know a lot of our members got into SCCO, and maybe even some of our viewers here got into SCCO, which was a copper play when we started talking about that in the middle of the summer. And look at that. That's up from around $95 to $105. So it's up better than 10% in this short period of time. Now look again at copper. I know I'm hopping around here. You didn't ask me about copper, but can't help but talk about this. Here's another bullish engulfing on copper. And then you look at mining stocks like FCX, which mines copper. What do you got there? Another bullish harami and a pivot or close to a pivot here off of a roll reversal support level. So there are a heck of a lot of opportunities here, Nod, in the precious metals and even in the mining stocks. I think if you're looking for a good play, I can only tell you that the mining stocks are going to be trading at a much cheaper price than most of the precious metals ETFs. So you want to keep an eye on those for sure.
Yeah, that discount has been great, and thanks for pointing that out to us early and often. It's paid off really well, so thanks a lot. Taking a bit of a shift, AJ, with all this jousting over the upcoming, we think, rate cut that's going to come, that's going to shake the tree on inflation. And one thing inflation directly impacts is housing. And if you'll remember, 2 weeks ago, we were fortunate enough to have our great member and home loan expert, Tim Lindsay. Hi, Tim. On, and he talked to us about that market directly. So if you look at this next chart that I have up, recently Redfin announced the number of homeowners households actually fell 10 basis points. And that doesn't seem like a lot of a big number, AJ, but it's the first time it has decreased in a very long time. And I believe inflation is to blame for that. So AJ, in looking at this chart and what I'm going to ask you to look at, Can you look at both Home Depot, HD, and then an inflation-related ETF, which is TIP, because Home Depot relies on people that own homes rather than rent. And then the inflation ETF is very important because that judges if people can afford homes or not.
Well, if you look at Home Depot, this is a weekly chart of Home Depot. It's had its ups and downs, but overall, it's still in a very wide trading channel here. Now, the weekly chart on Home Depot is showing a bearish harami, actually opposite of what we saw in the silver markets, after a bullish engulfing that followed, guess what, a bearish harami. So the topping pattern here is very confusing for those that are trying to make up their minds whether or not they want to go long or short. However, if you look at the daily chart, we got the full pivot. Now, I think you have to keep an eye on the Weather Channel as well, believe it or not, because we have not really had a very active hurricane season here in Florida. Thank goodness.
Let's not jinx it, please.
I know you recently moved to Florida, so you don't want to see those storms coming in. However, Home Depot tends to go up during hurricane season, which starts in May back here. So you have the May buy-in on a seasonal trade for Home Depot, but you also have a pivot point as we start getting towards the end of hurricane season. When you have an inactive hurricane season, Home Depot doesn't sell as many batteries and GNC or Generac generators to boot. So you really got to keep an eye on that. I think for the short term, at this point, I would not be a buyer of Home Depot, at least this point, unless or until it gets to a role reversal support here. Then I might go into the option markets. Now, you mentioned TIP. Is that it? Is that what you asked?
Yes,
okay.
Please.
Now, I also look at the 10-year. I look at the 10-year Treasury. So what's happening is if interest rates are going down, you have to understand that the bond market is inversely related to that, so it's going to go up. Here we have a pivot to the upside. See, we have a higher low. See that? Higher low, higher high. And we don't have a higher volume day today, but the oscillators are not fully into a sell signal, at least not yet. Now, I'm going to flip to the 10-year because I follow this quite closely along with TLT, which I'll get to in a minute. And if I back out on the 10-year yield, you could see that we've recently broken out of a symmetrical triangle here, which means this one could go a lot lower with regard to percentages. Now, the realtors are going to celebrate that absolutely, as people are sitting on the sidelines waiting for rates to go down before they buy a house. The realtors are going to get pretty busy right there. But if you look at the past history and what's happened with symmetrical triangles, here's an example what happened when it broke to the downside here and it went a lot lower. You see that? And then what happens after that, guess what? Another symmetrical triangle showed up right here, and that red candle right there was a big breakout below, and that followed the pattern exactly as how you would read it. So I think rates, the Fed is pressured, obviously, to lower rates. We'll have to see what that's going to do to inflation, because historically, when they ease like that, it welcomes inflation in. And I'm not quite convinced that we're not in a recession right now. If you look at the jobs numbers, which you report on quite regularly, you're going to have a lot of interesting data coming out. And whether or not that affects the market is to be seen. But we're making money. This week was one of the most incredible weeks for hitting targets. And our members are probably very happy, especially with the AMD trade that went out yesterday, for sure.
Well, that was a great one. I appreciate it. Look, we're making our friend Tim Lindsay happy with all this bullish commentary on the housing, and so thank you for that. Now, listen, AJ, more and more people are getting sucked into this AI ecosphere, rightfully so or not. And we've seen these numbers like today, like $300 billion thrown around with. I'm old enough that used to be a lot of money, but it's just crazy. But what I wanted to do is I want to pull up this chart real quick, and it's a little bit of a geeky chart, but just puts things into perspective. That just shows how the engine works, and it shows Microsoft on one side and Oracle on the other. Now, listen, Microsoft has been a great performer over the last couple of years, but as of late, it's been a little bit weak, whereas Oracle, as we all know, has just blown the doors off with their earnings and then with the deals that they're announcing. And in fact, if you look at this, look at the option activity in this alone. This alone made Larry Ellison, at least as of today, the wealthiest person in the world. So let's do a little mini rapid fire, AJ. Can you give me a little bit of a look-see on your end for Microsoft and Oracle, please?
Well, you're mentioning Larry Ellison. I got a bone to pick with him because some of you have been following me for how many years? 20 years. My tag name was the Option Oracle. And
yeah, we got a phone call.
Yeah, we got a phone call. He wanted me to remove Oracle from my service. It was the Option Oracle and the Equity Oracle services. We changed the names. Listen, I'm not one to cave in. You could ask my family that for sure. But the company I was with at that time really did not want to go through the legal battle. He has a lot more money than we do, and he could have kept us tied up in courts for years. So he changed the name. It's actually a better thing to do. So that I'm not gonna hold that against Larry and continually be bearish on the stock, because that's not something you want to do. Looking at Oracle right here, you can see we gapped up after they made their announcement, even after they missed earnings, believe it or not.
Yeah, it was a double miss.
This is an earnings and a revenue miss, and the stock blast through into outer space in one day. Now, I did not know this was going to happen, obviously, with Oracle, but I knew something was going to happen in that segment or sector, and that's why we went long AMD in the calls. And for those who are listening, let me just throw AMD out there, because AMD was a beautiful trade too, because that popped up on the heels of the Oracle news. Now, it gapped up. I know Anthony, who's listening in on here, he's running the show behind the scenes. I know he took his profit. It was like 40-something% profit in one day. You can't blame anyone for taking a big profit in one day like that. However, if you look at that space in AI, they spent, what is it, 300 and what, almost a third of $1 trillion.
It's mind blowing.
A third, folks, listen to that. A third of $1 trillion being invested into the AI space. Now, is it worth it? I don't know, but I'm telling you something right now. The experts in AI are saying this is going to be a race to see who dominates in the world's area here in this arena of AI. And it's being said that the country that dominates in AI is going to dominate the world with regard to information and control of that space. And so I don't know what to expect, because this is all uncharted waters. But if you look at AMD, I had a much bigger upside target on this one that has not yet hit. This looks like a flag pattern right here. Some of you have been following the flags. So here's a flag right here, right? Here's the flagpole. So how high could AMD go? It could go the length of the flagpole. It could test the all-time highs up here around 225. Now, for those who sold out of their AMD calls, understand that was a short-term trade. I most definitely will be keeping this on my list and waiting for the next pullback point to get into some more spreads or possibly some directional option trades on this. Now, the other one you want to look for, was it Microsoft, you said? Or
yes, please. Microsoft and Oracle, yes.
Okay, so this one is pulling back, believe it or not, to a role reversal. This is a weekly chart, and this is the role reversal area that I'm talking about. This stock tends to do this, folks. Role reversal, if you look back here, see this former resistance? Let me zoom in here. This former resistance right here held this resistance here, then broke out right here. There's the cup and handle. Can you see it? And then what happened? It held this support. So this whole area of resistance here turned to support here and here. And it looks like this one wants to pull back to another role reversal support level, which could take it off to the higher level. So do I think the general markets could still sell off? Yes, I do. But there's still going to be these mega cap stocks that are going to continue to charge forward. And if it weren't for them, this market had already been crashed a long time ago. The amount of money that's going into these companies is absolutely mind-boggling. And how do you decipher that? You really can't get into the details fundamentally, because it'll make you crazy. But the charts will give you a good snapshot to tell you which way the money is going, both in or out of that stock. So we got a lot of opportunities ahead of us here, Nod, for sure.
Speaking of opportunity, AJ, and I know you have some storms in your area, and you were gurgling a bit, but your internet seems to be back. But we've had some people chime in on the chat while you were talking about some of the profits that they've taken, and that's something that makes you and I both really happy, because you can set up a trade. But we've seen so many people ride a winner into a loser just kind of ad hoc here, can you talk about just the discipline and stress that it's okay to take a profit, and who cares if you leave some money on the table for the next person?
Well, make sure that if you're brand new to StickyTrades, make sure you check out our Technical Tuesday educational videos. They're very short, 8 to 12 minutes max. But if you go into that playlist, you're going to see how I talk about risk management using the 1% rule. Now, please understand the 1% rule has nothing to do with the percentage of gain or loss on the individual stock. Not at all. The 1% represents 1% value of your account. So if we were going to use simple math, you definitely take 1% value of your account, whatever that is, and you divide that by the risk per share. I'm just drawing this out with my little crayon right here. And when you divide the risk per share, which is the difference between your buy price and your stop price, that will tell you how many shares you get to buy. So in other words, if you get stopped out and the stock goes all the way down to trigger your stop, wherever that may be, the most you're going to lose is 1%. But unfortunately, what people do is they look at their accounts and they say, okay, how much money do I have in my account? And then they take the share price. I'm going to put SP here. They take the share price and divide that into the amount of money that they have to give them the number of shares to buy. That's the absolute worst way to get into a stock, and is the riskiest position you could take, because if that stock goes down 50% at that point, I'm talking share price, you're down on your account by a much bigger margin than just 1%. So you got to stay disciplined. I know it sounds easier than actually putting it into reality and putting it into the works of your trade. Not here. How about we do this? I know Nod gets crazy when I do this, but pick a ticker symbol from the audience.
Yeah, sure.
I don't know what it is, but pick a ticker symbol. I'll look at that stock. I'll show you where I would put my stop and how to calculate the amount, the share price, or the.
All right, so we'll go ladies first. Barbara is here with CLSK, please.
Oh, that hit my upside target, by the way. CLSK. This one did a great job. Look at that. This is the target. Now I still have an upside target on that at 1160. So this was 2 weeks ago. It finally hit the target today. Now it's gapped up and it's moving up. Now here, let's say you bought it today. All right, let's just look at this. Let's say you bought it at $10. Okay, that's your buy price. And you want to put a stop down here, maybe down below $9. All right, so you're going to put a stop at $9. What's your risk per share? Your risk per share is $1, right? So you take the risk per share, divide that into 1% value of your account, and there you go. It tells me how many shares you should be buying based on the 1%. Now, if I get stopped out, understand this, I get stopped out, I'm only losing 1% of the value of my account. But if the stock drops from $10 to $9, how much did the stock drop in percentages? It dropped 10%. You see? So I don't care about how far the stock is going to go. If I'm wrong, I'm still only going to lose 1% of my account. Now, if I want to be a lot more conservative than that, then guess what I do? I just put my stop $2 below my buy price. So instead of 9, I'll put it way down here at 8. I've got all this support level protecting me down here. And if I get stopped out, well, now I got a $2 risk per share, divide that into 1% value of my account. Now that would mean I would get to buy half as much had I put a $1 risk per share, but it's still a safer position because the stop is so far away from where the stock is actually trading. And that's how you manage risk, by a simple math formula. And that's it.
Well, you got people excited. Let's feed one more, if you don't mind, and then we'll go back to what I have. Let's go Hood, HOOD for TT, please.
Oh, this one, it stormed up vertically right here. It hit the resistance that I had put out 2 weeks ago. After hitting this downside target, I put another downside target. Look what happened last week. This kills me when that happens. It missed by pennies. Literally, it missed by pennies, and then gapped up shortly after hitting coming close to hitting that downside target. Now, first of all, risk management also starts with your ability to read the charts, right? Now, I'll put this one out there for the short-term traders. I would expect that stock to pull back to the close to the moving average. So I would expect about a 6-point drop in the stock. Now, if you decided to buy it, your stop would be somewhere below I would put the moving average or the gap fill point right here. So if you put a stop at 104, let's say you put a stop at 104, that's $13 below your buy price. You see that? So again, using your 1% rule, take 1% value of your account. Now you divide that by 13. Okay. You get to buy less shares, obviously, but you're still going to only lose 1% if the stock drops all that way down and stops you out. And for the option trades, we do something a little bit different in that we take the risk per option. So each option contract represents 100 shares. So if you buy a $4 option, the risk on that option is $400. So you take that $400, divide it into the 1%, and that will give you the sizing of that position. I'm watching that clock.
I know. I'm ready to jump. So before we leave, I want to get into some volatility. A lot of people smarter than me, AJ, say when the bond market speaks, we should listen. And if I pull up this chart here, this is the MOVE index, which is the volatility index for bonds. And if you look, it jumped the last few days, which was the biggest 2-day move since April. So AJ, before I ask you to give your thoughts on your preferred bond index, whatever you want, I would also like you to talk about the VIX. Since we last spoke last week, it's moved from 17 to 15. So there's some volatility in both directions. So when the bonds move and the stocks don't move, it makes it trading tougher. So can you opine on both, please?
Well, if interest rates are going to drop, obviously the bonds are going to go up. So
Right.
There's going to be a lot of activity there. And I don't trade the bonds directly. I think that's more for the investors. If you're a bond trader, you could ask folks like John, who's one of our members, to talk about bonds. He was a professional bond trader. But I like trading like TLT. I'll go back to that. This is a way to trade the treasury bond. It's a treasury bond ETF. And you're not spending all that money. But the beautiful thing about this is that you've got options galore on this TLT. And you could do all kinds of conservative spreads, whether it be credit spreads, debit spreads. You could go directional with it. But let's say you buy it outright and you want to hold it just for a play in the bond market. Look what happens here. They actually give you a yield that is very, very close to what the yield on the bond is going to be at maturity. So while you're holding it, at least you're getting paid to hold it, right? In sync with what the interest rates are on those bonds. But yeah, we've got, and now with regard to the VIX is still on lows that I haven't seen in a long time, since back here. Actually, these are the lows from 2024 at the end of 2023, actually. But if you look at the VIX, we've got a bullish engulfing. It's hard to see that little red body candle, but we got a bullish engulfing. Now, that means that the buyers are most likely to come in to play the VIX than the sellers. And if you look back here, bullish engulfing, you see it, bullish engulfing. Here's another bullish engulfing. And what happened after those bullish engulfings? They went straight up. Now, if this red candle here, if this green candle here would have been red, that would have been a bullish engulfing. So I don't trade the VIX. I know a lot of our members do through VXX and UVXY, but I use it more as a leading indicator to make sure I'm not on the wrong side of the market. And that's why when the VIX is low, I tend to be more bearish in our spreads than bullish. And I just got to do a shout out talking about bullish. Eli Lilly has made a nice run from the lows here, 625. Sure. It's up almost $100 from here, $125 actually. And our option traders, I got to do a shout out to the super spread option traders. We had an amazing credit that we rolled into, a $13 credit on our Eli Lilly position. And so that is the end of our 30-minute segment. Folks, thank you so much for joining and liking and commenting and putting those ticker symbols into the comments field here in the live broadcast. Make sure you catch the recording. If you have any questions, you could go back to that recording on YouTube and add your comments, and we'll be sure to read every single one of them. So, Nod, thank you for joining us today. Thank you, everyone. We'll talk to you next time. So long.